Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. There are growing recession fears in the markets globally and also some disquiet over the narrow breadth of the rally in the US markets, being very confined to these mega cap tech stocks. So there's an increasing amount of caution from market commentators, even the previously quite bullish outlook from some of the research analysts that we cover has become a little bit more circumspect. So there's a rising bearishness in the markets. But at the same time, valuations are still attractive, especially in non-US markets. And even in the US markets, if we exclude those mega cap tech stocks, then valuations are not too bad. And of course, we are going into a phase where interest rates are more likely to be cut than to be increased. And of course, that's always positive for the markets. We are longer term investors, conservative investors. It means we are more or less prepared for any market eventuality. We've got a lot of different asset classes, well diversified across currencies and geographic regions. So we should be able to take on any knock to the markets which could arise. And of course, bull markets do climb a wall of worry, so it's natural that there should be some concerns around the markets. China's economy, some fairly upbeat remarks from Capital Economics. They say that they've been more bullish than most on the near-term outlook for China's economy for a while. The incoming data continues to surpass their upbeat expectations. Given the encouraging signs from the Labor Day holiday, which was a 5-day holiday, Capital Economics now expects GDP to expand this year by 6.5%. So that's up from their previous forecast of 6% and well above the consensus forecast of 5.6%. We start off with JP Morgan Cazenove, the equity strategy. We believe that the consensus view that the worst of pressures is behind us will be proved wrong, as the impact of monetary tightening has worked historically with a lag. Labour markets are lagging indicators and could weaken abruptly. Continued Q1 strength doesn't necessarily mean anything for the second half of the year. We held a view over the past 2 years that corporate earnings would be resilient and argued that Q1 results would still be robust. But this is likely to start changing into the second half as pricing power wanes. What about AI? Tech companies have done a masterful job of playing up the promise of AI. However, the monetization of the technology on a scale that will have a meaningful impact on the industry's sales and earnings is still years away. For the majority of tech firms, AI is unlikely to be a game changer for the trajectory of their earnings over the next 2 years. We are less pessimistic about the outlook for software and IT services stocks, which have more defensive business models. Again, more caution from Capital Economics on their asset allocation outlook. While a narrowing in the US stock market has not always been a signal that a rally in equities is about to come unstuck, we still think that it could foreshadow a poor outlook for US equities over the rest of this year. Underpins our forecast that the S&P 500 will end 2023 at 3,800, about 9% below current levels. MRB slightly more circumspect, more reserved, more cautious than they have been in the past. They do admit that the pause in interest rates will be supportive of equities, bonds, credit, and other risk assets. But they feel that the US debt ceiling battle looms as a near-term threat for capital markets and the global economy. The tussle between economic bulls and economic bears will likely persist, implying continued choppy markets. And they're also slightly worried about the banks. There's little precedent for global stock-bond ratio to deviate directionally from bank stocks on a sustained basis. Bank stock prices will almost certainly need to stabilize or rise anew if the global stock-to-bond ratio is to continue to advance. But valuations, as I mentioned earlier, not looking too bad. Valuations, the global benchmark, equity benchmark, is trading in a 12-month forward P ratio of just under 16, close to its median level since 1995, almost 30 years. And then there's a pronounced difference between the US trading at nearly 19 times versus the global ex-US benchmark at just under 13. So the US trades at a 20% premium to the 30-year median, while the global ex-US trades at a 12% discount. A little bit more caution from Absolute Strategy Research. They believe that the fastest monetary tightening in 40 years is starting to bite, looking at money supply data and credit surveys. The equity market appears too complacent regarding recession and credit risk. Equities are vulnerable to margin compression. We could see a peak to trough earnings per share decline of 20%. And meanwhile, cash is a strongly competitive asset class at these levels, with US one-year Treasury bills offering 5% yield. Cash remains attractive in a world where recession risks are still high and rising. Interestingly enough, they've turned slightly bearish on the Eurozone, where they believe optimism has run too far given weak money and credit data. They're still overweight the US and overweight Japan. And what about inflation? So interesting or fairly sobering assessment from Absolute Strategy Research, but it's difficult to argue with. Taking inflation or taking stock of the inflation shock, we are now 2 years into this inflation episode, and it remains uncertain just how far inflation will fall over the coming year. The truth is, 2 years into this inflationary episode, there's still little consensus about its underlying causes and huge uncertainty about where inflation might settle. From an accounting point of view, unit labor costs have explained most of the rise in core inflation since the start of the pandemic. Workers have managed to resist an erosion of their real wages. And this is Olivier Branchard, economist who used to be with the World Bank. He suggests that inflation is fundamentally the outcome of the distributional conflict between firms, workers, and taxpayers. It stops only when the various players are forced to accept the outcome. This implies that regardless of what caused the inflation problem, firms and individuals' unwillingness to accept weaker real incomes is sustaining it. If behaviors really have shifted, will the mild recessions we expect be enough to bring inflation back to 2%? That seems less clear. So Now on to more solid footing. We're going to talk about the holdings and the global portfolios. It all looks incredibly positive. Very strong performance from Murray International, one of our portfolio stalwarts. NAV returns in the financial year plus 8.8%, outperforming the minus 7.3% return for the FTSE All World, a yield of 4.2%.
Thank you, Nick. As you all know, I am Gielie. Locally, not much is happening. AB InBev, they've now updated the revenue with actual figures. Last week we didn't have figures for that. The revenue is up 13%, which is fantastic. But unfortunately, earnings per share is up 8.3%. So it's clear that there was pressure from inflation and costs were up. But the volumes were up just a little bit. It was up 1%. Glencore announced that it will build the biggest battery recycling plant in Europe. By 2026, European car manufacturers will be obliged to use batteries made from recycled material. And the recycled material is mainly lithium, cobalt, and nickel. Just something about the import of cars into South Africa. We have experienced a big surge in the import of cheaper and affordable cars from the East, mainly from India and China. This is exactly the market where Motors is very active, a very positive sign for them. Then SARS, there was rumors that they've scrapped the 10 million annual foreign investment allowance. There were reports that this, in the newspaper, there were reports that called it silent and violent moves by the SARB. But the answer is no, it's absolute. The tax expert says it is rubbish. And it's not one of them. Several of them said that the report is total rubbish. It's not the truth. There will be more strict in future, but that's all. And then a sale of local equities by foreigners. It's still below 30 million a year to date. So it's standing still. It was over 30 billion, but it's back to below 30 billion at the moment. Then electricity, there was fears that our electricity grid would collapse. But we are not alone in this matter with this problem. Botswana's grid collapsed on Monday, which is very bad for us because they export electricity to us. They export 60 megawatts to South Africa. And from the SARB again, they introduced new banknotes and coins last week. The notes and coins will be introduced incrementally. And then car sales for April, the number of cars sold was 37,000. For the year-on-year, this was flat. Vehicle exports is 30,000 for April. That is up strongly. It's up 13%.